Perhaps you have seen the headlines of millionaires and billionaires pledging a portion of their wealth to charity. While I'd like to believe that they're genuinely passionate about giving to social causes, it is important to acknowledge that there's also a significant benefit to their income taxes. What if I told you that this strategy is not limited to millionaires and billionaires, but that you can also take advantage of it to reduce your taxes and potentially make an even bigger contribution to society? Find out how. Hi, everybody. This is Jose De La Rosa with SimplyEZTax, an accounting and tax practice with over 20 years' experience servicing all U.S. states remotely. My brother and I started this practice to make taxes simply easy. Tax planning today can help reduce your taxes and plan for a better future for you and your family. Let's understand the differences between giving to charity and pledging to charity. We typically give to charity by transferring funds to the charity of our choosing. The non-for-profit gives us a receipt confirming that we donated, say, $5,000 in 2023. We then give this document to our accountant, and he or she uses it to calculate your itemized deduction that will reduce your taxable income. In contrast, a pledge is transferring income or assets from your account to your very own charitable investment fund. The pledge of $5,000 will sit in a donor advised fund that is controlled by you. You can choose to donate to charity in the current year, delay the donations for future years, or invest the funds where it can grow tax-free, like a Roth IRA. The contribution is an irrevocable commitment, meaning that the funds cannot be returned to the donor for any purpose other than donating to charities. You may be saying to yourself, if in both scenarios you're donating $5,000, what is the benefit of a donor advised fund? Well, here are the top 3 reasons. 1. Tax efficiency. Traditionally, donations come from income that you've already paid taxes on, like on wages, business income, capital gains, etc. Under the donor advised fund, you can contribute cash, but you can also pledge securities like stocks, mutual funds, ETFs, real estate, business shares, and even cryptocurrencies. By transferring these types of assets, the tax savings include the capital gains tax you would have had to pay, the charitable tax deduction that you will receive, and if you move the right asset, the charitable impact to cost ratio can be higher. Here's an example to illustrate. Say you have 50 shares of Apple with an average cost of $50, and the value of the stock is $120. You would have had to pay around $500 in taxes. On the flip side, by transferring the shares to your fund, you would have a tax deduction of $6,000 that would lower your taxable income. The impact to cost ratio is 3 because it costs you $2,500 to buy, but the impact you're making on the charity is $6,000. 2. Maximizing impact. The average charity spends almost 40% of its donations on overhead. In essence, out of the $5,000 donation to charity XYZ, you can expect $3,000 of it to go to the cause itself, while the remaining $2,000 spent on administrative costs like salary, fundraising costs, professional services, etc. Donors that contribute to their fund create their own foundations. For example, say you contribute $5,000 every year to your DAF for 20 years. That's $100,000. You can create a private foundation to make a bigger impact and hopefully reduce the overhead versus donating to charity XYZ that may spend $40,000 of your donations to administrative costs. 3. Control. By retaining control of your fund, you have the option of self-directing your investment or having it managed by someone else. All value appreciation is tax-free, which will ultimately benefit your costs. There are a couple of caveats that I want to bring to your attention. The special deduction of $300 for single filers and $600 for married file jointly filers expired in 2021, and you can no longer take this deduction for 2022. To maximize the tax benefit of your contributions to a DAF, ensure that your itemized deduction exceed the standard deduction. The annual income tax deduction limit to charities, including donor advised funds, are 30% of your adjusted gross income for contributions of non-cash assets, if held more than 1 year, and 60% of adjusted gross income for contributions of cash. Contributions amounts exceeding these deduction limits may be carried over up to 5 consecutive tax years. Please consult with your accountant to help you structure this tax benefit.